Welcome to Market View with Ike Ios and friends. This show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now.
Good morning. Mike Ios, your host for Market View Guest. My very good friend, Mr. Mark Arbeter. Hi, Mark. How are you?
Great, Ike. How you doing?
I'm doing well. And Mark, over the last 3-4 weeks, we can observe two things. One, with regards to the S&P, is that it has been trading in a very narrow 100-point range. That is just 2%. So that cannot go on for very long. Either it's going to break out of that range or it's going to break down. At the same time, we've seen Nasdaq underperforming the S&P. So I'm curious to hear your thoughts for both going forward based on their technical picture.
Yeah, certainly both the Nasdaq and the Qs, if we compare them to the S&P 500 or the Dow, have different chart outlooks at this point right now. The S&P has been grinding higher, while the Qs and the Nasdaq and tech in general continue to kind of pull back. Some of the high-flying COVID plays have really gotten destroyed. Of course, they went up, too far, too fast. The first chart here is the triple Qs or the Nasdaq 100. We had a 513 EMA bearish cross. It's just a short-term sell signal here about a week ago. You can see that prices pulled almost right back to the green line, which is the 50-day simple moving average. That's pretty common during an uptrend. The question now is, we saw a failed breakout, or is this a cup and handle with a high handle? We won't know. The danger, if we break the 50-day, there is some trend line support down 315 area, 320 area. But I think if we broke the 50, we might go right through there and come all the way back down to the prior lows in March below 300. You also note that the pink line is the 200-day moving average. We got, great distance, 200-day, 200-week, doesn't matter. All these indices, most of these indices, and sooner or later you're going to come back and revisit these averages. If we go to the next chart, this is the Nasdaq, same time frame. Is this a potential double top? We won't know that for a while. Has to break the intervening low. We did get a 513 EMA bear cross about a week ago, same time as the Qs. The Nasdaq actually fell a little below the 50-day. This is the 50-day EMA. So far it held. We had nice strength here this morning. We also have some trend line support here. We had nice strength this morning on that weak jobs report and the very quick decline in interest rates, but rates turned around and doesn't look like, almost look like we filled a gap here, ran up to the 13 EMA, and then have been kind of selling off the rest of the day. So not the greatest action here. So if there was one area, I'd keep an eye on, be a little concerned about, be the Nasdaq, the Qs, and technology in general. As you said, going to the next chart, the S&P 500 been in the channel. We broke out of the channel and kind of have ridden the top of the channel higher. During the last week, we had a very, very minor pullback right to the 21-day exponential moving average. This is common support during an uptrend. We did get overbought. We worked that off. So there's really not a lot to say that's negative about the S&P 500 chart. If we go to the next, we have an S&P weekly chart going back to 2018 with the weekly 20-week Bollinger Bands wrapped around price. I've shown this chart numerous times. Typically when you get into a grind higher, wave 3, move higher, you kind of ride the upper band. Sometimes you'd come back maybe and test the middle band. but you basically stay in between and you kind of hug that upper band. If this is going to continue, there's a couple measurements we can get for potential targets, and targets are always subject to change. Based on the V bottom we had from February to August, the size of that, if we had a 79% extension of that base or V bottom, we'd get a target of 43.43 on the S&P 500. And if we had a full 100% extension, we could have a move up near 4,600. There are also targets higher than that. I don't really get into them yet, but I have a couple targets up near and above the 5,000 level. But right now, like the daily chart, there's not a lot to complain here, except, which we've talked about, the index is very far, still near 40% above its 200-week. That's on the bottom pane. And that will be corrected sooner or later, as it always is. Then if we move to some breadth figures for both the S&P and the Nasdaq 100, breadth remains very strong for the S&P 500. 92% of its components are above the 200-day moving average, and about 81% are above the 50-day. These are very strong numbers, certainly when you put them together. So breadth for the 500 is not giving any warnings, whatsoever. However, if we move to the Nasdaq 100, as I said, it's been a little weaker, a little sloppier. We have pulled back. The percentage of stocks in the NDX above their 200-day is 82%. That has been consistently strong if we go back to last year. And, so we have a long way to go as far as the number of stocks, the percentage of stocks breaking down below the 200-day before I would get too worried of a very large decline. Basically, you wouldn't want to see percentage of stocks fall below the 45 or 50% area. And, we're a long way from there. But you can see at the second pane, the shorter term action of a lot of stocks is basically neutral. You got about 54% above the 50-day. So it's almost 50-50 here. So a lot weaker than what we saw on the S&P 500. So all in all, I think things still look very good for the stock market. Not a lot of warnings other than sentiment, which I won't talk about because that hasn't worked for almost a year now. But as far as breadth and price action, everything still looks very good for the stock market.
Mark, anything else you'd like to add? Any other thoughts, observation about other markets?
Yeah, I haven't looked at oil in a while. Oil had broken down from a head and shoulders top back in late March, and we had no downside follow through. So we never, while we completed the head and shoulders, we never really completed a measured move to the downside based on the size of the head and shoulders formation. And that's certainly a tell. I've talked about that. When you don't see that, you probably going to get a nice move to the other side, which we have. We're up in the 65 area. We're very close to the prior high from back in early March, near 66, 68 area. So it looks like, this might be a cup here to eventually take out those prior highs. If we do, and based on the size of the cup, which is about $10. This is a WTI here, which is about $10. We could easily see a move up into the high 70s. And I will note that the XLRE, which is the leader here in 2021 so far, year to date, the XLRE is actually breaking out. It also put in a decent price consolidation, maybe a cup, but on a closing basis, it's hitting new highs, new recovery highs over that early March time frame, just when crude oil was peaking out. So that's a sector, value sector, and a sector that has done well this year, lagged terribly the past 2 years. We're also seeing continued strength in the financials. And so it's, it's just flip-flop of what we've seen over the past couple of years. And I really think that's going to continue.
Mark, thank you. Have a great weekend.
Thank you, Ike. Thanks for having me.